We'll give another minute and then we'll kick it off. So maybe I can start with my introduction and in general, and we can then get into it. Thanks a lot, everyone, for joining us today. It's been it's amazing this whole open series, how this has grown into what it is right now. I still remember 15, 20 years ago it used to be a very selected group of people coming in. So I'm thrilled to be here, and thank you everybody to be here in this room today. This is something that I'm very passionate about, and we'll be focusing on 3 different segments today. The first one being AI and big data linked to investment, the low-cost automated investment that is taking place, and last but not the least, the capital market trends, or what is capital market trends. And before I do that, I just want to set up the stage that we are actually living in this stage of digital economy, what I call digital economy, where buyer has all the power. Instead of in the older world, if you will, in the industrial economy, where seller had all the power, you build a product, you put it in front of a customer, and the customer will have to do things around it. That is no longer the case. It's all about buyer. Either we are buying our phones, either we are investing, whatever we're doing, buyer is one very much educated, and he or she knows what to do. And that brings in technology, and that's why we are here today. I think it would be fun to have some discussion. We have a very nice set of panelists, distinguished panelists in here. Why don't I start with Poya. Poya Tegal is the founder of Big Data Federation, a technology company that predicts business fundamentals, economies, industry inflections, and secular shifts using the big data and AI. Poya was the CTO of Cisco Video and Collaboration Group and Intel's Off-Mobile Wireless Group, where he led a team of 150 plus wireless and networking experts located in 3 continents. Poya holds over 25 issued and pending patents in wireless networking, security, big data. Thank you, Poya, for being here. Jeremy Pollack is a regional director at Fidelity Institutional Asset Management and client service organization dedicated to meeting the needs of consultants and institutional investors. He also holds the Certified Investment Management Analyst CIMA designation and the Financial Industry Regulation Authority FINRA Series 7 and 63 license. Welcome, Jeremy. And then we have Ting O'Connor. Ting is a managing director at Merrill Lynch Wealth Management Services. Ting joined Merrill Lynch in 2000, focuses on delivering a comprehensive approach to managing wealth supported by global resource of Merrill Lynch. Ting's experience and commitment to her work was recognized by Forbes in 2019 when she was named one of the top state-by-state advisors. Welcome. And last but not the least, Imran Jaffer. Imran is the founder and CEO of Total Wealth Solutions. He and his skilled team has been managing wealth for high net worth families for almost 20 years. He started his career with Merrill Lynch, but in 2003 he decided to take a different route by forming his own advisory firm. Imran has been recognized as a leading wealth strategist and has shared his insights at events and conferences nationwide. Among other recognitions, he was recently featured in Top 100 Financial Professionals for 2018. Welcome, Imran. So with that being said, and as I was saying earlier, that our focus would be on AI, big data, low-cost investment, capital markets. Poya, why don't I start with you? What is the basic fundamental difference you are seeing in the traditional human interface and something that you are working on with big data and AI?
So yeah, thanks so much.
You need to turn it on. Yeah, I'm sorry.
Okay, now it's on.
Yeah.
Can everyone hear me? Okay, good. All right, so what we do as a technology company is we are not really coming from financial backgrounds. So we basically started to analyze and integrate a lot of data that we realize is out there. And in a short few years now, we process over 45 billion data records a month. 70% are refreshed daily. So the data we use is from whatever you name it, from satellite, weather, import, export, prison population, to smoking, to just name it, cyber attacks, activities like that. What we realize is that a typical company of S&P 500 is just beginning. There's over 700 good correlation between their revenue, macroeconomic indicators, global macroeconomic indicators. In other words, a lot of these businesses have very little control over where things would head for them. And them looking at their internal data can only give them a very limited visibility, because it's only the order of this they get to see. So from there, we actually started to predict these companies using our available data, no enterprise data at all. And we have achieved very high accuracy on predicting the sales and the margins, gross margin, operating margins. And we even predict what they may give a guide coming into the quarter. So we started selling that, and now we roughly predict 2,200 companies with extreme accuracy, fully automated. And every day we're adding more data, so every month our data size is growing by 10%. So we believe that just the same way that the trading moved to the machines, the fundamental analysis would ultimately move to machines, and the spreadsheet analysts and humans cannot possibly predict fundamentals accurately. We have seen that across the board. The most active funds, the hedge funds, have been underperforming the market since 1994. So not 1 year, not 2 years. So that shift is going to continue. Yeah. Yes. Oh, I just hold it. Manually, yes.
Yeah, there you go.
There you go.
It's much better.
So I can sit back now. So if you actually look at it, just the same way that when things move towards automated trading, and even passive funds, the active fund could now be moved towards machines.
Talking about very quickly on one thing on big data, and then we'll go to Jeremy very quickly, but if you can just do a very quick follow-up. Alternate data, so even in investment, so we're talking about general data that is already available there, for especially in your field of big data. How do you see this whole alternate data, where you mentioned some of different kind of data sets that are available? Yeah. What kind of trend are you seeing?
So there is so much data out there. I don't know if you guys know that pretty much every train that goes across the United States, the load is known. We know where it's going from A to B, what's in it. Every train car, every plane, we know almost what passengers are in it. We don't know individuals. We know the traffic coming in, going out. It's all out there. The amount of information that is out there is no longer able to be processed by spreadsheets and humans. And what we have seen, the alternative data that people have done is, our brain is wired to do one-dimensional correlation. That's what we do. We look at, we get one data set, say it grew 20%, so yeah, there's a good correlation, so this one is going to grow 20%. Correlation is actually a very, very bad thing to consider. If you actually look at the Facebook revenue, it's correlated to the global warming. I mean, that is where.
Cool. Yeah, I mean, and just to add to that, is that when I was at Thomson Reuters, one of the things, again, looking at data and investment, we took off all the rigs and all the boats and everything that is taking oil from destination 1 to destination 2 to provide that information to the investors and the traders so that they can trade and say that certain oil, how long will it take to get to destination and how would that change the whole dynamic of even the stocks and so on and forth. So I think really using technology to our advantage, both in investment and trading, has been a big thing. Jeremy, very quickly, and we'll come back to you on that, but for you, on what scale Fidelity is using AI, big data, and how effective, more importantly, I think it's one, are they using, and more important, how effective is it?
So obviously, short answer is yes, Fidelity is making massive investments, and has been, into artificial intelligence, big data, machine learning. And as Youssef was mentioning, as it relates, and it's happening in multiple facets, multiple areas of the organization. As it relates specifically back to how we're picking stocks, or how our portfolio managers are picking stocks, we are still, we are a fundamental analysis shop, sort of by nature, but understanding that there are trends and that we can unlock and use this as another data point, right, to help and assist our portfolio managers in picking those stocks, picking the right securities. And as Youssef mentioned, let's say predicting earnings out 3 to 5 years. That is most certainly an input that Fidelity is using. I think it gets exciting as that artificial intelligence starts to get a little bit smarter, right, and actually maybe ask the question like, why is this data important? And again, they'll incorporate that into security selection. Now, in terms of how effective it is, you can look at, I would say, go back to benchmark performance. Like, are we beating benchmarks? And if you looked across the complex in a variety of different asset classes, you're going to see, to the tune of like 83% of our funds outperforming indexes. So is it all AI? I can't say it's all AI. I'm not, like I said, I'm not a portfolio manager, but I do know most certainly that is a big piece of what we're incorporating now and into the future.
You wanted to do a quick
Oh yes, I forgot to say we also started a fund, and it's fully automated, fully run by machines, and it runs 2 strategies. One is it just trades on the earnings based on our prediction. The other one actually invests in companies. So it's a little too early, but since the beginning of the year, the earnings strategy has returned over 21%, and the long strategy has returned over 27%. This was in January.
Awesome. Ting, so I have 2 questions for you. The first one is that how do you recommend investing in AI? I think that's a very interesting. One thing that is set up is that AI is a thing, it's here. So how do you do? And the second thing, I'll just make a comment that, again, AI is something that I'm very near and dear to. One thing I've seen is that women, they are really on top of it. There are a lot of great, I see like, they are on top of it. How is it different for a woman in AI? Why are you guys better at in that? So if you can.
Thanks for having me. So the first question would be, how do you invest in AI, or how use AI, for investing? So it's the same answer. Basically, 3 things allow AI to exist right now. 3 things. 1, data. Everyone's talking about data, right? It's a big data boom. So we use data, big data, what we call the Monte Carlo simulation, to run the plan. At the Merrill Lynch Report Wealth Outlook, it's a trillion or billion data. Just run the scenarios. We use that for planning tool. Number 2, the speed, lightning speed of processing, right? That has to happen in order for AI to exist, right? So we use that to analyzing all the data and modeling. For example, someone would just say, some client just say, oh, I decided to help my son buy a house. I need to come up with down payment for them. How are they going to affect my goals and objectives, right? Before, we had to go back and tell our Fidelity is our partner, by the way. Should we do that? So with the 5 seconds, we plunge in. If you decided to help your daughter or your son buy a house, this is what you sacrifice for your retirement income. Immediately, it's a lightning speed. And number 3 is the cloud computing and the storage. These 3 things I have to recap: big data, processing speed, and storage. Storage at Merrill Lynch, we have a document vault. So if clients wants to share with us, with their living trust, with their will, with their whatever, divorce certificate, they don't have to give us a copy. They just in the cloud share with us. And that's a huge, we call the storage, we use in eBay. So in terms of AI, investing in AI, we invest these 3 sectors. Okay, awesome. We have a leading company for all these 3, data, speed, and storage. Okay, awesome. So to go back to women investing, women are very grounded. Okay, if we ask husband, what's your goal? Or making more money. Usually men would say, making more money. What are you going to do with more money? Just making more money. That's all my goal, right? So wife will say, wait a second, honey, you can make more money in order to do goals, right? So women investing are more customized, individualized. They know exactly what we're going to do with money. Money is a means to an end. I'm going to use money to send, to fund open, to donate, to whatever, right? It has to be goals behind the money, okay? So women investing very, individualized. Team tell me that if my goal is to have $1 million retirement income, by the way, if I can fund that goal, my secondary goal would be send my kid or grandkid to Stanford. How is going to impact my overall, wealth, right? So women are more grounded, very individualized goal. That's number one thing. And AI is not our competitor, by the way. AI is our good friend. Because they don't know you. Maybe in the future you can talk to a machine, but they don't know you. Fidelity, they don't know who you are, what's your risk, what's your fear, or greed, whatever, but we know. So that's we call the human touch. It's still there. That's we call the emotional-based advice. That cannot be replaced by AI yet.
That's a great point, Ting. Imran, going to you, how do you see AI fit into the wealth management, specifically into the wealth management?
Sure. So I'll bring the mic close to me. So technology or AI is here. It is in our lives. It doesn't matter it's personal or business. You invited or uninvited. It is here. Technology can be incredible. In our case, in my case, I think what it is as long as it's creating human connection, enhancing the human connection. And I'll give you an example. So let's say, they already talked about the technology side, but let's say I'll give you the relationship side. So let's say I'm picking up the phone and I'm talking to my client. I'm saying, hi, Asif, looking at your investment mix right now, and I see that you have this kind of investments with me, and I have run algorithms of thousands of algorithms based upon the data right now and the trends right now. This looks more interesting, and this looks more, which we can optimize your investments. How do you think that conversation will go from there? The client is going to say, of course, and it's a satisfied client on the other end. What does it make me? It makes me look good, powerful, it makes me look informed, it makes me look knowledgeable. So that's the business side of the aspect, but infrastructure side of the aspect is it organizes, it syncs in a flash of a second for me, for us, optimizes my time, optimizes transparency, optimizes overall situation so that we can deliver more, basically.
And just to follow up, Imran, I think it's a good segue going into talking about going from AI and big data to go about low-cost automated systems. We hear so much about robo-advisors, and it's a thing now. It's getting very popular. What do you think? I mean, again, from a wealth management, what's your view in there?
That's an excellent question, Asif. So let me ask you this here. So I'll take you through a journey here. So let's say you graduated and you get your first car. That first car takes you from point A to point B. You get a space where you crash in, you can just afford it at that time. But as your needs grow, what happens? You get a different car, you get a new house. So let's put that into financial aspect. So as financially you grow, in the meantime, in the first time, like you are just getting paycheck to paycheck. And as you're growing, what is happening? Your financial needs are growing. Now, do you need a traditional 401k or a Roth 401k? Okay, a time for stock options. Which stock option? Where and when should I choose to exercise? Then comes the point if you're starting a business. What structure should I be choosing? And if it's successful, what should I be doing with that business? My share should be allocated to which person in my family to get me protection and get me minimize my taxes. Can Robocop do that? No. A robo-advisor do that? No. Okay. On the other side is, it doesn't matter which route you take, business or your professional life you take, you accumulate wealth at a certain stage. Now, how do you transfer that wealth? What's the best way? Succession plan. This is where a human touch comes in. Okay. Recently, the tax law changes that impacted each and every one, and in different ways. So I don't know if you guys know this, but if you have in a certain tax bracket, if you are getting passive income, it's going to hurt you. But what vehicle to choose that is not going to hurt you is going to enhance it. So basically, fee is only an issue when the value is not added. And I say it all the time, it does not matter how much money you make. What matters is how much you keep in the end.
Yeah, no, that's a great point. Ting, to you, again, and just building up on what Imran was saying, the low-cost services like robo-advisors, who is the right audience for robo-advisors? And again, going back to your employer, the Merrill Lynch, how are you using it? What do you see? And again, how you segment that?
I have a Merrill Lynch colleague here, so they can verify what I'm saying. So at the Merrill Lynch, we love low cost. Low cost, we wish it's free. We really wish. Without it can offer free, there's nothing there for free. But low cost is our friend. The reason being is the robo-advisor we're using at the Merrill Lynch is called Merrill Lynch Guided CIO model. So basically, we as an advisor know who you are first, articulate the goals. As like Imran says, finally, investing is my ending. We call the investment process. It's the ending part of the investment process. We find who you are, we allocate the funds for your different goals and make sure it's prioritized, right? Your primary, secondary, and the third. At the end, how to deliver. Deliver is we use Fidelity, we use Vanguard, we use the free, robo-advisor to achieve that goal. But we are still the quarterback of the whole team, right? How to allocate the funds, those things.
Awesome. Jeremy, do you want to add anything on the Fidelity side? Again, from I'm emphasizing on this robo-advisor so much that it is a thing, low cost, and again, it's how it actually sort of customizes at least the perception is. Again, from your perception, Fidelity, how do you see it, and what's your view?
Yeah, I'll piggyback off of what Ting said, right? When it comes down to actually building the portfolios, Fidelity offers both active and passive management. We've got low-cost solutions, and the idea of incorporating them together when building portfolios is most certainly a concept, right? That we embrace, that we incorporate, when actually helping to construct portfolios. I think there are spaces, I would say, where paying somebody, I call it spending active budget, like where I'm going to hire a manager to go pick stocks, let's say in emerging markets, or certainly fixed income. There's a lot of data around the fact that we can beat indexes when spending that active budget. But Tay makes a great point, right? And so does Imran. You need somebody to have a quarterback there. Portfolio construction is one small piece of it, right? It's working in navigating through those life events. Spouse dies, kids go to college, second marriage. My risk tolerance changes on a weekly basis because the market's up and down. I mean, that's where that's where you need somebody working with you, right, to help you navigate these things. So we believe in it, but it's only becomes useful when you got somebody sitting behind it to help you actually understand it and let it work for you.
Well, what's your view? Because again, my question to you is that, again, we have these folks, our friends sitting in here talking about really nicely deciphering the value of robo-advisors. My question to you is a little different but yet same, is that do you think investment products demands by a different segment of users can be predicted by machines? And obviously there is a strong view that there is, but what's your view, and where do you sit in that whole?
So I mean, just one comment on robo-advisors there. They went after low fees, low cost, but they're really worthless. I mean, most of them haven't really done much. Now, that doesn't, but there was a time that it did cause some challenge to the active management or advisors, and as my colleague also mentioned, the active management, the advisory part of things are necessary. People have different life changes, they go through divorce, new kids, new disease, and all kind of things that would require those kind of special attention. But those are special cases. Majority of the things we go through is very predictable. We'll wake up, in an hour or so you're having your breakfast. In the next couple hours you'll be at work, and then 8 hours later you'll be home. 10 hours later you'll be home. Most of the human day-to-day life and activities are fairly predictable. And to your question, would machines be able to actually pick? Yes, but not the current setup that we have. These robo-advisors were basically rule-based. In other words, how old are you? What's your income? When do you want to retire? You answer 4 or 5 questions, and they have a bunch of statements, and then they say, okay, that's what you should be doing. Reality is that's exactly what a lot of financial advisors are thought to behave to. That's not learning. That's once the data is available and it's processed, in a mass scale, the learnings that machines can do is incredible. But that does not mean it would replace some of this, it would empower the advisors in a different class, instead of them sitting down picking stocks, they would think bigger things.
Cool. So one thing that I'll say, and sorry I haven't said it, that if you guys have any questions, as I'm asking questions, please raise your hand and we'll be more than happy to do that.
Yeah,
Mohammed.
my question is, you mentioned this automatic program QA, which made 21% in the last 2 months. That was a good time. How it could have predicted back in September, October, December time, or 2007 or 2016?
We don't have that much history on this one, but I can tell you, for example, the fund went into cash completely in August last year, and it just stayed on and started buying in December again. So, and it's not technical trading, it's just fundamental, where it actually measures evaluation and the fundamentals shifting. There were bad predictions coming out from the macroeconomy where it actually picked and started to narrow the investment. So, as I said, there's 2 strategies we run. One is a long strategy. Whatever we do, that is correlated to the market. The other strategy is on the earnings, and that is really not correlated to the market. If you look at Restoration Hardware, last week, 2 weeks ago, they reported they missed the numbers, stock went down 30%, and the market was up a couple percent. And there's no correlation when the earnings come out. It's so powerful, it overwhelms the market for that one company. So,
Yeah.
One more question is, what about the human perception? Because that affects, otherwise you could have predicted the stock market and Imran would be out of business anyway.
no, so there's different tasks here. I think what
I don't predict stock market.
What Imran and others do is a service really needed because people need to have a strategy for their life. That's a different thing. But when you actually narrow it down to individual stock picking and all that would be...
Yeah, no, and I think that's a good segue to what you asked, Mohammed, is that, Imran, you're from an independent channel, if you will, right? And which is, again, in this whole setup that we have right now in the digital economy, because of the flexibility, I feel that it is really, there is a lot of advantage to it. What is your view? What does a common investor, like what Mohammed was asking, what are the red flags? Can you just give a view, a little bit view on that of what it is?
Sure. So, actually, I've been when I've been driving, I've been listening to these radio ads. 12% return. Real estate is a very popular asset. Everybody likes to own. So you will listen. I'm sure everybody here listens to those ads on the radio. It says, "Oh, 12% return guaranteed. Never lost money." You have, right?
Yeah, 2007 was a very good year to show
Yes. So now the thing is, when you talk about red flag, if you hear anywhere, and it's just blanket statement I'm making, where it says low risk or no risk, high return, run. That is, when you're investing somewhere, investment doesn't mean that you cannot lose money. All these firms you see right there, they see in a bull market, everybody's a genius, right? Are you guys with me? Everybody's a genius in a bull market. So in last 10 years, if you bought real estate or any index fund or anything from Stockton to Los Gatos, you made money, right? The real challenge comes is in a bear market. How do you hold on to that? And all these, like these companies, if you, on your personal, buy real estate anywhere from New York to California at this point, I can guarantee you cannot make more than 4 or 5% cap rates. That's also on a good investment. How are they doing 10, 12, 13% leveraging? So when the things go bad, what happens? These companies will fold, these companies will file bankruptcies, and then after 5, 6, 7 years, they will come back again with fancy names, fancy brochures, and you know why people will invest again in them? Greed and short-term memory.
Yeah, changing gears a little bit on really looking at trends, and we can always come back to that. Tim, to you, the China trade policy has been focused on for almost a year now. China has always been a very strong player in emerging markets. How do you see that? And one, do you see any new, leaders emerging in the space, in the emerging market?
Well, I'm looking for from China is to really opening their market, capital market. That's the last resort they try to hold on, is the capital market. So right now they're going through this, the negotiations been going on for 6 months now, right? Why? It's not matter, oh, I buy more soybeans from USA. It's not, they have tons of money. We can buy whatever you want us to buy. That's not the issue. The issue is, if you wanted me to go through the structure, reform, that's a little bit impossible, to the Chinese leaders. So we're waiting for that. The moment when China open the capital market, that will be huge. We invest in the, because China market is also the AI driven. They hold the patents like by 200% in 5 years. They have all the patents in China. Baidu is the #1 player in China. So we're waiting for that moment when they finally wake up. So you know what? We're going to migrate into this. I don't want to say mega trend, it's a tsunami trend. It's a 15.7 trillion economy, created by AI. So that's 12 times of total wealth of Australia. Just think about that way, right? So China has to bend a little bit from here. But we don't know more details. Let's see, right?
And any new emerging market?
India. We love India. The reason India had GDP.
It's the wrong place to say that.
GDP is 7.2%. They surpass China right now. So we love Indian banking system, because they heavily invest in the AI. In the we call it blockchain, right? Those. So that's one of the.
I'll come to you in a second, but just to do a very quick follow-up from just going from Merrill Lynch to Fidelity. What is your forecast by Fidelity from your research team in the capital markets?
Yeah, and so two big, again, I'll piggyback off Ting. So last year, I'm going to set the stage, very good fundamental economic year, right? We went from 1% to 3% GDP. We had 22% earnings growth on the S&P 500. We had sales were up 9%. Margins were up 16%. Lowest unemployment rate since 1969. Wage inflation went up, which is great, right? Because people are making more money. The more money people make, the more money people spend. 70% of the U.S. economy, the GDP here is based off of consumer spending. Productivity went up from 1.1 to 1.8. It's going up to 2.3% this year. So on the surface, not even on the surface, like fundamentally phenomenal. I would say we had a phenomenal economic year in 2018. That being said, right, the U.S. stock market in December, was down 13.52%. We finished down about 4.4%. So what were the big black rain clouds in the way? Ting is talking about one of them, the trade deal with China, and the other is the Federal Reserve, right? And they were raising rates throughout 2018. Let's fast forward to today. right? Federal Reserve firmly on the sideline, not raising rates, probably not going to cut rates, but at least for 2019, they are on hold. And our folks in our Washington group is very confident that we will get a trade deal done with China. Now, and you remove that, so we got one big black rain cloud on the sideline, we get this other one taken care of, and yes, the market's up, call it 16% year to date, but we're still in, we're in great shape. So we see more upside in the stock market. We still like equities more than we like fixed income. Base case for recession is still mid to late 2020, right? So Fidelity, we're feeling, I would say, cautiously optimistic at the moment.
Awesome. Well, you have
So regarding China, it's a good market. We have concern about the real estate market. There is over 70% of all purchases in big cities are done by investors, not by home buyers. And the government is the VCs, the investors, everything. They fund companies, they go and buy products from them. So market opening up may be beneficial to them, may also harm them. That's why they have been a little bit protective. If they were not protected, there would not be a Baidu over there, there would be Google there. If they were not protected, probably there would not be an Alibaba there, there would be an Amazon there. So opening up the market got some interesting risk for China coming up too. But the economy is also very much stimulated by the government, and they're super efficient in getting the stimulus to the market very quickly, unlike the United States. Economy, as our colleagues said, we also predict no recession right now. Sometime next year we still cannot see, but the economy is slowing down. So the market is kind of holding up, we believe, because of some China deal, and the fundamentals are pretty good. But let's see what comes out of the China deal. I think after that, it's going to be, oh my God, the economy is slowing down.
Yeah. So there's a gentleman at the back who wants to ask. Please tell your name and would be good.
Yeah, my name is Mohammed, and my question is just about one little thing. Like, if AI is in investing, so how is it possible that AI will take into consideration the non-financial data, like the wars between countries, like different foreign policy deals going on between countries, because this will impact the big data as well. So just want to know that how is it possible, and if it's possible, that would be great, but I just want to know about that. Thank you.
So the way we use that, we call those latent impact. If you actually look at, a war does not change the fundamental very quickly. It impacts sentiment quickly. The fundamental will get impacted, with some kind of lag. In most cases, that is the case. But the way we actually look at it, we look at for quantifiable things. So one of the things that we track and we build ourselves is called terrorism index. So the terrorism index, we also track crime, corruption in countries. It's incredible what World Bank publishes. And those have incredible connections to actually wealth and well-being of our market. So,
Thank you.
Yeah. Hi, this is Arif. And question primarily to Puya. So when you have big amount of data, how do you analyze and where do you get your decision making from? Is it like data science? What is that is done on top of it?
Very, very good question. So we don't use correlations. That is a really bad metric, as I said. Global warming, temperature, and Facebook revenue correlation. It's a very good one. So what we do is we actually go underneath. We look for things like principal components. We look for things that if we remove the general trends out of things, what's left? That would start, applying and figuring things out. A lot of people ask, what's your model to actually predict this thing so accurately? The answer is really, we don't know. Every single time the new data set arrives, the algorithms change them all. It is very dynamic, and it is learning, and what we do is extremely hard, and we have been going around talking to people. We're very confident about what we sell it to institutions, and we have fun, and the enterprise take it too.
This is going to be the last question for the day.
Hi, Amar Pervez. As we look at the last few recessions that we had, and you look at the yield curve, it has always been inverted prior to a recession. And as you look at the yield curve right now, and look at LIBOR compared to 1 year, 5 year, 10-year money, it seems to be inverted. Not a whole lot, but a little bit. Is that a cause of concern? How do you guys view that?
Let me go to the recession thing, right? Because this all leads to recession kind of thing, right? Do you know when the data or the study has been done, how long does the recession last? Anybody here? No, 8 months to 18 months. So average out is 12 months. So as long as, if you have a shorter time horizon, you should not be investing anyway, right? So on the other side is that if you are investing, you should be in quality products or solutions. And the perfect example is 08. If you were at the right place, even in 08, the downturn happened, nobody has been able to predict the recession in the last 40, 50 years or 60 years. Nobody. There have been speculations, right? But there have no been. Yes, those are concerns, but if you look at it, the market, even with the bad news, goes up every day. Or there's no news, goes down every day. And the same thing happened in December. And December was the worst month in the stock market in the last 20 years, 25 years. And do you know what January was? The best month in the last 20 years, 25 years. So going back to, do we know the recession is coming? I can tell you, nobody can tell. But if you have a short time horizon, you should not be in riskier investments. And the second thing is, if you are, be in quality. And you should have some dry gunpowder, yes.
Guys, I'm getting these angry looks from at the back that the time is over. So thank you very much. I think it was very engaging. The panelists will be here. If you have any questions, please feel free to ask them one-on-one. Thank you very much for making time and be here. Thank you, everybody. Thanks a lot.
Thank you.